Okay, so we've just started the recording. Yeah, welcome everyone. And so today we're going to continue on from what we were doing previously. If you remember in the last lecture, so in lecture 2 of employee benefits, we actually didn't complete all of the lectures. So we stopped just after considering the non-accumulative leave. We didn't do accumulating or cumulative leave. We only did non-accumulative leave, and we didn't look at vesting or non-vesting. So today we're just going to go through the vesting and non-vesting stuff. If you have lecture, if you haven't watched or been to the lecture, please go to your content, the learning content area, the learning area, and you'll find all of the videos there that can help you. Is it compulsory to join lectures? It's beneficial for you to join lectures because you are going to get stuff in the lecture and you're going to be able to ask questions. It's going to be tailored. If you really can't make it and you would rather watch the video, then you're welcome to watch the video. But just know that your questions are probably not going to be asked. And if something is explained and no one really asks about it, then I'm just going to move on. So if you find that you're struggling with a concept, and today we're gonna deal with some concepts that we might find a bit tricky, you might want to just put up your hand and ask a question. So yeah, so under your content learning area, you're going to see that the slides will be updated as soon as we finish with this topic. I'm going to update the slides. And so the slides that you find now that I'm going to refer to today in class might be slightly different. There's just one or two things that I've changed or words, or in fact, in today's slides, there's a word that I need to correct, incorrect spelling. So I'll just correct that while we go through it today. And yeah, okay, so let's get started. So if you remember previously, let me just show you the slide so to jog your memory. So previously in last week's lecture, we actually spoke about the non-accumulative leave. And when speaking about the non-accumulative leave, we did that small quick example. I don't know if you remember this example here. And we basically said that when leave is non-accumulative, we're not having to create a liability. If you remember yes, so this afternoon is a repeat of this morning's lecture. So for those of you that were in the morning's lecture, you probably don't need to be here now, but so it's a repeat, it's the second group. So um, in the when we did the non-accumulative leave, we said that there isn't a liability that's created. So today, I just want to talk a little bit about what we were speaking about previously with the difference between cumulative and non-accumulative leave. Remember, we said when something is cumulative, it means we can take it to next year. We can move it to next year. So if you don't use it, you don't lose it. That's the key. So you can take it to next year. Where something is non-cumulative, if you don't use it, you lose it. So if you haven't used it in the year that you incurred it or you earned it, it then disappears. And so that's why you can see the sort of diagram next to each of the statements is indicating the direction in which the amount of leave is growing. So cumulative increases over time or should increase over time, and non-accumulative would decrease immediately at year end. With a cumulative leave, so the leave that we're able to take from one year to the next, with that type of leave, what is actually happening is you might find that we are transferring some sort of value from one year to the next. So we're having leave from 2002, let's say 2021, we are moving it into 2022. And so because of that, we're transferring value from one year to the next. And therefore, we need to create a liability, right? Because the worker is transferring value from one year to the next. And so we create that liability as a company because now we owe the worker that leave day, right, with cumulative leave. That does not exist with non-accumulative leave because you can't move it from one year to the next. The next thing is vesting. So with vesting leave, it means you can change it into cash. Vesting leave, you can change into cash. Non-vesting leave, you can't change into cash, as if you don't use it, it will disappear. The word is forfeited, right? And so remember we said that we want to pay careful attention to those types of words oh, sorry, I accidentally stopped sharing. So we want to pay careful attention to the words that we're using or the words that we're seeing in the question. So when we see words like forfeit, then we know immediately forfeit must be something that's non-vesting. But if we see something like cash, it can be converted into cash, then we think to ourselves, oh, if it can be converted into cash, it's probably going to be vesting. So let's have a look at cumulative leave. So the first thing is, like we said, with cumulative leave, we are changing value. We are taking value from one year to the next. Remember when we spoke last week, we said that in a given person's salary, the company or the employer, the company actually creates or bakes into that salary the leave. So when, for example, you are going to work, when you go to your company to work, the company knows that you're entitled to, let's say, 15 days of leave in a year. So when they're paying you on a monthly basis, they're expecting you to take those 15 days, right? They're assuming that you're going to take your 15 days. So though that 15 days of you taking paid leave is actually baked into your salary. It's already there. It's already accounted for in your salary. So that's an important concept that we're going to return to later, right? That leave is already incurred in the salary, but it can only be incurred in the salary for the current period. That makes sense, right? So obviously we can't pay you for leave that you're going to get next year. We can't pay you for it this year. So we're only going to pay you for leave that you've sort of going to take this year, and you can only earn leave when you actually do work. So as a result of you being at the company and working on a day-to-day basis, you earn a portion of leave, right? In the same way that you earn a salary. So it doesn't make sense for us to sort of increase or pre-bake into our leave into our salary the actual leave for next year. So basically what I'm trying to say is leave is only accounted for in the year that the work is done. So when we move leave from one year to the next, we are creating a situation where we've done work, we've gotten paid for it, but we're moving some of that value, a portion of that value that we got paid, we're moving it to the next year. So because of that, the company needs to create a liability. But when they create a liability, they have to take into account whether the leave is vesting or non-vesting, right? As I said, vesting means that it's going to be changed into cash, right? And non-vesting means that it can't be changed into cash, but they can take the leave as a leave day, right? So the days are still available. The time off is still available, but cash is not available under non-vesting. But vesting, both the days as well as cash might be available. So if you look at those two things, right, think about this in your head. When, let's say, we have an employee, so a worker, we have a worker, and that worker carries forward a day from 2020 into 2021, right? So he's taken it from last year and he's carried it forward into this year. Now we've already accounted for it. We've baked it into last year's salary, okay? So we need to create that liability and carry it over. If that worker takes that day of leave, okay, in 2021, number one, we need to account for it based on the 2021 salary because he's taking it in 2021 and his salary might have changed. He might have gotten, like an increase in his salary. So that's the first point. Number two, if he takes the leave, so that means that he's worked part of the month, and part of the month he's taken leave that he brought over from 2020, we still are liable. We still have to pay our form of contribution. So we still have to, the company still has to pay him for that, pay his salary, as well as pay the contribution, their portion, the company's contribution for that month, right? So the fact that someone takes leave doesn't decrease the company's contribution. Okay, so there's no change in the company's contribution when someone takes leave. As a result, he is actually, the employee or the worker is actually taking leave and getting the contribution. So he's getting sort of two things. He's taking leave from last year, which he was already paid for, and he got a contribution for, a company contribution. But he's also taking this year. So there's sort of like an acknowledgement that there's an extra cost on the company. When now we look at a different scenario. That's one scenario. He's used the leave, right? So we're going to call that using or taking leave when he actually takes the leave days. If we look at another scenario called vesting, so where he changes it into cash. If someone works the entire year, they don't take the leave, but at the end of the year, they convert that leave into cash. The company or the employer does not need to pay an additional contribution for those leave days that were taken, right? So the company doesn't pay an additional company contribution for those leave days that were taken. So we've got a situation where if the leave is paid out, he only gets paid out his gross salary. He doesn't get the company contribution, because remember, the company contribution doesn't go to him. It goes to third parties. So it goes to medical aid, and it goes to Provident Fund, and it goes to UIF. So when he's taking the leave out as cash, that extra company contribution is not being paid out to him. Okay, so that brings us to an interesting concept. Now, this is a critical concept. You have to get this, right? Very important. So I'm going to try and spell it out for you in a very simple way. When a company pays leave, so it's paid out in cash. When a company pays leave in cash, it is only the gross salary that the worker can get. The worker only has access to the gross salary. Therefore, when we are measuring leave that is paid out, we only use the gross salary amount as a basis for calculating that leave. All right? So the first rule is leave paid out, we use the gross salary. In a different scenario, if the leave cannot be paid out, but the leave has to be used, when I say used, I mean a day is taken, a leave day is taken. So if the leave has to be taken, then the company will have to pay a company contribution for the day that the actual employer was on leave. You get it, right? Because remember, a company contribution is based on a month, right? So a company would say, we're going to pay 500 Rand towards your medical aid in 1 month. So if the worker works for 29 days and takes the 30th day of leave, and that leave happens to be an amount that they brought over from last year, we have a situation where the company still needs to pay the contribution for the full 30 days, even though the worker did not work for the full 30 days. He only worked for 29 and he took 1 day of leave. So therefore, we need to account for that company contribution for that 30th day, that day of leave that was taken. So if something is used, if the leave is taken, we don't use gross salary to calculate that leave. We use cost to company. Now remember the relationship between cost to company and the gross salary in a slide that we looked at last week. If we have a look at the slide now, so we've got the company contributions, right, which are simply those amounts like Provident and medical aid and that sort of stuff that the company pays on behalf of the worker. And then we have the gross salary. Now, gross salary is that amount that includes the net salary plus all the worker's contributions. So the worker's deductions. The worker might contribute also to medical aid, also to Provident Fund, also to UIF, etc. And so the gross salary includes that amount. Only when we put these two amounts together, so when we add the company's contributions to the gross salary, do we get what we call cost to company or total cost to company? So what we're saying is, if leave is paid, right? So if leave is paid out to the employer, we're going to put it here. If leave is paid out, then we're going to use gross salary, right? But if leave is taken, so if they take an actual day of leave, then we can't use gross salary. What we have to use is, let me just change my thing. So this is if the leave is taken, or sometimes we might say used. So this is if the leave is taken or used, then we have to use total cost to company, because the company still has to pay for that day that the leave has been taken. Okay, any questions about this concept? This is an important concept, so I don't want anyone to be lost. Maybe we can, in this time, we can write a small sort of rule in our books, in our notes, and that rule is going to be, if leave is taken, right? So if the leave is taken, that means that the person goes on leave, it's cost to company, right? We use cost to company, but if the leave is paid out, we're going to use gross salary. Okay, so leave taken, so that's what you're going to write down. Leave taken equals cost to company, leave paid out equals gross salary. Okay, so we've got a poll on the screen now. I'm just going to type out a few things while you guys read the poll. Okay, poll should have popped up on your side. Let's read the question together, and then we can discuss our way through it. So it says, why is gross salary used instead of cost to company when leave is paid out? Right? Remember we said when leave is paid out, we're going to use the gross salary. So this question is asking, why is that the case? Right? So the first option is the leave is not taken or used, therefore it is not a cost to the company. Thus, we do not use cost to company. B reads, the employee or the worker, let's use the worker so that we don't get confused. The worker will not get paid out the company's contribution. So this is where I said I was going to make that little change. So it's supposed to read here, this is supposed to be an R. So it's not going to be the company's contribution or the employer's contribution. Okay, and then C says the worker does not receive any bonus, therefore the measurement must be on gross salary only. Okay, so those three options again, the leave is not taken, therefore it's no cost to the company, and therefore we have to use cost to company. Therefore we can't use cost to company at least. And then B says the employee or the worker does not get paid out the contribution. Okay, so it doesn't get paid out the company contribution, therefore we must exclude it. And based on our calculation, if we exclude company contribution from cost to company, we then left with gross salary. And the last one is that because there's no bonus paid out, we have to use the gross pay. So let's take a few seconds and answer our poll, and while I have a look at the chat. So while you're busy answering that, I'm just going to answer one of the questions. Someone has asked, why would someone get paid out rather than take the leave? So it is a personal choice. There's no fancy answer to that. It's not accounting related. People generally make these decisions, on their own. Some people might need the money as opposed, so they don't mind working, they'd rather have cash in hand. Whereas other people, you know, are working such hectic jobs that they just don't get time to take leave. So that's why they'd rather, there's no option left but to have it paid out. Yeah, so there's various sort of there's various reasons, but it definitely is something that happens in practice. Yeah. Okay, so there's 9 people still we're waiting for to make a contribution and to sort of answer the poll. So if you're one of those 9, please try and answer the poll as fast as possible. Okay, so these are the answers. So the majority of people have said A, but if you have a look at it, there's quite a lot that have said B. The correct answer is actually B. Okay, we use the cost, we use the gross salary to calculate the amount paid out because the worker is never going to receive an additional company contribution. Remember, we said the additional company contribution must be paid when the leave is taken, but if the leave is paid out into cash, the worker doesn't receive an additional company contribution for getting the amount paid out, right? They only get paid out the gross salary. And as a result, the answer there B, where we said the worker will never get paid out the company contribution, is the correct answer. In terms of if A, so A might sound right because it's saying there's no cost to the company, but there actually is a cost, and the cost is the gross salary that is being paid out, right? Because remember, when you're paying out leave, you're giving them their monthly salary, and in addition to that, you're paying out the leave. So there's that cost of the additional leave being paid out. Does anyone have any questions about that? I can see someone put on their mic. But there's no one's got any questions. Okay, so that's why. So the actual cost to the company, it might not. So the cost to the company is the gross salary. Yeah, and so that part A is actually, or option A was actually sort of trickily worded. It was worded quite interestingly, where the examiner or the person writing this out said like cost to company, and they played on that word. It's basically like an English play on words. They played on that word cost to company and made it seem as if they're talking about salaries, but they're actually not talking about salaries there. Okay. So now we're just going to quickly go to our test your knowledge in accounting. So the blue book, this book here, test your knowledge in accounting book, and we're going to turn to 11.4, and that we just want to do that example. So it's on page 139, so 11.4, and we just want to do that example together and just see if we can grasp sort of what is being said. I'm also going to read the question with you so that you can see sort of how I read questions, and hopefully you can learn something. Okay, so the question starts off, and so we're just reading under information. We're not going to read the required. The required's on the screen now, but we're going to come back to the required just now. So the information says the following information is available from the records of Sheraton Limited and relates to both years of 20X1 and 20X2. So we already know that they're dealing with 2 years. It says the annual salary for an employee. So we're dealing with one person here, so one worker. We're dealing with one worker, but the rules that we learn in this example can be used and are transferable when we are talking about multiple workers. Okay, and then it says the employer or the company contributes the following to contributes the following for this worker. So the first is 1% of gross salary goes to UIF. 8% of gross salary is a defined contribution plan. And remember, we spoke about defined contribution plans in very briefly. We covered it we just touched on it in lecture 1 and 2, where we just said that we have to recognize it separately because that's considered to be, it's not considered to be a short-term benefit. Remember, we learned about short-term benefits and post-employment benefits. There's a difference between the two. So defined contribution plan is going to be a post-employment benefit, not a short-term benefit, whereas the others are more likely to be short-term benefits because it's going to be finished and paid off in 12 months. So that's that, and then it says 500 rands, so 500 rand per month for the medical aid fund. It then says assume that there are 250 days per year. So this is an important thing that you're going to see in all of your leave pay questions, is they're going to tell you what amount to assume the person works during the year. So I want you to just highlight that, and in all of your questions, I want you to look out for that amount, right? So the amount can differ, so it's not always going to be 250 days. Sometimes it can be 261 days. Sometimes it can be 365 days. So it can change from question to question. So you have to look at the question to make sure that you know how many days are working days in this question. So that's important, right? So look out for the 250 days per year. It will change in every question. It then says the employee or the worker is entitled to 20 unpaid annual leave days, for which 5 may be carried over to the next financial year. Now, let's just stop there. So carried over, that word, that terminology, carried over, moving over to the next financial year. That tells us what, right? That tells us, when we see the word carried over, that tells us that it is cumulative leave, right? Remember, we said cumulative leave is leave that goes from 1 year to the next, right? So leave that originated, was created in 2021, and we moved it to 2022. That is a cumulative leave. So here it's telling us the leave is carried over. What we're trying to say is the leave is cumulative, right? So write down next to those words a cumulative, because that's important, right? And then it says, after which the leave will be forfeited if not used. So again, another word, forfeited. What does that word forfeited mean? That word forfeited is telling us that it's non-vesting, right? So we're dealing with a non-vesting leave. So it's a cumulative and non-vesting. It says, it is the company's policy to first utilize accumulated leave before the current year's leave can be utilized. So it's just basically telling us the pattern in which they use it. And this specific pattern is what we call FIFO. So first in, first out. The leave that is the oldest gets used first, right? And so that's what it's being saying here. Cumulative leave is always older than the current leave because it was brought over, it was accumulated from last year. So therefore, it's saying the old leave will be used before the new leave is used. So that's what that statement is saying, and we can write there in our textbooks. This means that it's FIFO, right? So it says the financial year is 31 December. Leave taken by the employee was as follows. The employee utilizes 15 days annual leave, 15 annual leave days, and carries 5 over to the next year. So immediately let's stop. So they're carrying 5 over, they received 20, they used 15. How many are they allowed to carry over? Right? So the question, if we read just under there where it says assume 250 days, that paragraph just under there, it says the person is entitled to 20 days, right? Of which 5 can be carried over. So the limit is 5. So in this case, if the employee only used 14, we would have to artificially limit them down to 5. We can't take over 6, 7, 8, 9, 10. It has to be 5 or less, right? So we would have had to bring their leave balance down, but it's okay in this scenario because they have used exactly 15 days, so they have only 5 left over, right? So we can just move that to the next year. So in 2022 or 20x2, it says the employee takes his full 20 days of the current year, as well as his accumulated 5 days leave from the year 20x1. So how many leave days has he taken in total in 20x2? How many leave days? Tell me in the chat, how many leave days has he taken in total? Yeah, that's correct. So he's taken 25 days. So what I want you to do, if you're reading a question like this, where you can see the examiner now is trying to trick you, I want you just to write down in the question, he's taken 25 days. So that when you're rushing later on, when you're doing your test and you're rushing later on, you don't accidentally look down and see, oh, there's 20 days here, he must have taken 20 days. You see your writing, you see 25, and then you know that he's taken all the days available, right? So remember, he was given 20, he's wiped that out, he's taken that, and he was accumulated 5, and he had accumulated 5, he's also taken, so he's left at the end of 20x2, left with nothing, right? So he's taken all of them. Right. So what is our task is we need to try and record all of what we've read, right? And we need to journalize all of what we've read here. So let's start off first with the salary. Now, under normal circumstances, it wouldn't just be this simple, right? We wouldn't just have the gross salary. Generally, in a test question, we should assume that we're going to get a broken down gross salary, similar to what we did when we were doing the first 2 lectures, right, where we had the gross salary and it was broken down into UIF, Provident Fund, medical aid, and then we had a net salary that was actually arriving in the bank account of the worker. So in this example, it's overly simplified, and I think because the reason why it's overly simplified is the important part in this is not the gross salary calculation, it is actually the leave calculation. So the question is trying to target the leave, and therefore it gives you a very simple gross salary. But we should not expect our questions to be this simple, because all it requires us to do, this question just requires us to have that. If we now turn our attention to the slides, if we have a look at the short-term employee benefits here, this is an expense account, right? So this account goes to profit and loss. It's always an expense account. So it's going to profit and loss. We're going to debit or we're going to create the expense, increase the expense on the debit side. And previously we used to call this account salaries and wages, right? Now that we've learned about employee benefits, we can't call it salary and wages anymore. We have to start to call it short-term employee benefits. Short-term meaning it's paid within 12 months of the work being concluded or the work being done. So, so the first is that we're going to record this, we're going to increase it. Now, in the question, there's nothing here that tells us that they are paying the leave late or they're paying the salary late. So we can assume that they're going to use bank, right? So we can assume that bank is going to be involved because they're paying it out. But in the exam, if you actually, or in the test, if you actually use some liability, right? So some sort of salaries payable, or you might, if you get a full question, you might, so I'm trying to write the word payable here. It's not going too well. If you get some sort of question where the person might have employee benefits, is some sort of employee contributions, so worker contributions, worker deductions, like UIF, like medical aid, you're going to see that this bank amount is going to be broken up into many different journal accounts, right? So many different accounts. one might be medical aid, one might be provident, etc. So that's how this first journal entry should be composed. We chatted about this last week, and we said that this journal entry was very similar to what we did in first year. Okay, so nothing new there. In this one, we have to remember split. Remember, we don't split the contribution or the provident contribution in the last. In this journal entry, we don't split the provident contribution. But in this one, we have to split the provident contribution, and you can see the provident contribution there, where I've now put the blue mark. And we have to split it because, remember, it's not included in the gross salary. In the previous journal entry, the contribution of the worker was included in the gross salary. This contribution that is being made now by the company is in addition to the gross salary. So therefore, it's an additional benefit, and therefore it needs to go to a different account. It can't go to the short-term employee benefits account because it's not short-term. It's post-employment benefit. So it needs to go to a different account. It's also an expense, right? So if you have a look here, it goes to P&L, and so it needs to go there. How did we calculate it? We took the 100,000 Rand, which is the gross salary, and we multiplied it by 8 as they told us to, right? This is the company's or the employer's contribution. And then when it comes to the short-term benefits, in the short-term benefits, what we did is we took the UIF, which is 1%, times 100,000, and then we added, right, there's the plus, we added to that the medical aid, and the medical aid was 500 Rand a month. Because we're dealing with an annual situation here, we look at the annual amounts. And how do we know that it's annual? Because when we look at the question, it says the annual gross salary. So we knew that all of the amounts here were annual, were yearly amounts. So we multiply that 500, which is the only amount on the question that's by a monthly amount. We have to multiply it by 12. Okay, so we multiply it by 12, and we get 6,000 plus 1% of 100,000 is going to give us 1,000 Rand, and that gives us a total of 7,000, which is that amount there. And obviously 8% of 100,000 is 8,000 there. And then we add those two amounts. Again, we're not being told that they're going to keep the money. We're not being told that the payment is delayed or any such thing. And therefore, we can assume that bank account is probably the best account for us to use. And therefore, we can put this to bank. But in the test to exam, we can also use, just like we did for the worker side, we can also use some sort of payable, some sort of liability. So the name that we give that account must reflect that you know what you're talking about, right? So it should be something along the lines of, provident payable, and then we'll put the 8,000 Rand there. Then we'll have maybe a medical aid payable, and then we'll put the 6,000 Rand there. And then maybe we'll have UIF or SARS payable, and then we can put the 1,000 Rand there. So it must reflect, so you must have that word payable or liability to reflect that you know to the examiner, to the marker, I know that this is not a profit and loss account, it is a balance sheet account, and it's a payable, it's a liability. So make sure that you word and you label those accounts. If you don't use bank, and in some cases you might not be able to, because they might tell you, listen, the payment is not being made until later on in the year. So then you're going to have to make sure that you have the word payable there to let the examiner and marker know that you know what you're talking about. You know that it's a liability. You know that it's a balance sheet item. Okay. So that's pretty easy, right? So far, pretty easy. We've done it before. Now, remember we said when we wrote down our rules a little bit earlier on, we said if something is paid, if leave is paid out, if it's vested, right? If leave vested, if it's paid out in cash, we must use what? Which one do we use if it's paid out in cash? Tell me in the chat. Correct. Gross salary. Right. So if it's paid out in cash, we use gross salary. If it's taken, right, then we use that thing called CTC, or cost to company. If it's taken or used, if the person takes the leave day and goes on holiday, then we use cost to company. So in this case, what do we think is happening? So if we have a look at the last sentence in the question, 20x2, it says the employee takes the full 20 days of current leave as well as the accumulated 5 days. So he's taken the leave, right? He's not gotten paid out. So the amount that we use has to be the cost to company, which is the gross salary plus the contributions, right? Remember our slide that we looked at last time. Gross salary plus contributions give us cost to company, right? So let me just find that slide and put it for you guys. So we want to calculate the cost to company, and we do that by taking the gross salary. Now in our situation here, the gross salary is 100,000, right? So we're going to take our 100,000, and that's here, right? So we take our 100,000. So now we know, sorry, that's a million. So we take 100,000 and then we add the contributions. Now in our question, we were told that the UIF of 1%, the 8,000, the 8% of defined contribution, and the 500 Rand, and we calculated that already in a journal entry, and we've got an amount of 15, right? So we add those two amounts together to get our cost to company, which ends up being 115,000, so 115. Okay, so that's the amount that we are going to see at the top of the slide here. So that's what that is, right? So it's 100,000 there plus the 15. Now we were told that there's 215 or 250, 50, right? 250 working days in a year. We want to know what is the cost for the worker to work 1 day. What is the cost to company per day, right? So that's what we're looking for, the rate or the cost to company per day. And so we take our 115, so 115, and we divide it by 250 days. And then we get 460 days, 460 rands per day. Okay, so our cost to company is 460 per day. Okay, and everyone's got that, right? That's not too difficult, and we know why we used cost to company, because of the person using the leave. So he's taken the leave, he hasn't gotten paid out, right? So what we've done there is we've calculated the cost to company per day. Now we know that the person is taking 5 days from 20x1 to 20x2, right? So he's transferring 5 days from 20x1 to 20x2. Okay. Now, is there an increase in the salary? So if we look at the question, we read the question again, it doesn't tell us anything about the salary increasing. So we don't need to increase the cost to company per day, because it's the question is silent. If the question is silent, we can assume that there's no increase, right? So therefore, what we do is we take the 460 times 5 days, right? Because that's the amount of days he's trying to transfer, and we're going to get 2,300. Okay, so in our next journal entry, that's the journal that we're going to pass. Now, why are we passing this journal entry? Because what we effectively are saying is, in the cost to company for 2021 or for 20x1, in the cost to company for that year, we included a total of 20 days. The person only used 15, and he's taking the value out of 2021 or 20x1. He's taking that value out, and he wants to use it now in 20x2. He wants to use it next year. So we need to pass a journal entry to record that exchange of value between the years, to record that even though we've paid him a salary, we still owe him this extra couple of days. Okay, does that make sense, right? So we've paid him his gross salary, we've paid the contributions on his behalf, but we still owe him this extra 5 days. And because we owe him something, in addition to his salary that he's going to get paid in 20x2, we owe him the 2,300 Rand. So that's how we calculated the 2,300 Rand. So 5 days multiplied by a rate of 460 per day is going to give us the 2,300 Rand. And the liability is created, a liability is created because we now owe the worker these 5 days. Okay. So someone is asking a question. We are calculating the cost to company if the leave has been taken. Are we going to use the gross salary if they don't take it? So obviously in this question, if they don't take it, the leave is forfeited, right? So we would have to scrap this amount. We'd have to reverse this amount if they don't take it. So that's the first thing. But remember, this is a journal entry that we're passing in 20x1. So this is to create the liability. When the person actually does use it in 20x2, we're going to come to the next journal entry where we have to reverse and say we've already paid, that value has now been used up. So this is the first step in recording for this leave. The first part of recording this leave. That's the first thing. Let's have a look at the next question. It says, what are we going to do with the 5 days carried out of 2021 because they have not been used or taken out in that year? So this is what we're doing. This is the journal entry that we're passing. So if you have a look at the year here, it is 2021. We are passing the journal entry in the 2021 year to say that we owe this person the leave. They haven't taken the leave, and therefore we want to record it as a liability at the end of 2021. So that when it does get taken in 2022, it's already sitting in our books and we know that we owed this person the leave. So that's what we're doing. This journal entry is happening in 2021, and it is the recording of the 5 days that haven't been used. Okay, so we're not yet recording the days that are being used. The days were only used in 2022. So when we come to 2022, in the next slide, we're going to be recording the usage of the days. Now we're recording the fact that we still owe the days. Okay. So now we skip ahead a year and we are sitting in 2022 here, and the worker has actually used up their days, right? So the worker has used their days up. Now that they've used the days up, we need to record the fact that they've used it, right? So they've received some sort of benefit. They've received some sort of increase in value because they were able to take leave, right? Or they were able to take a vacation, right? And still get paid for it. So they're able to take 5 days of vacation and they were getting paid for it. So there's a benefit that they've gained. Do you get what I'm saying? There's something that they've received. And therefore, we have to, now what we can do is we can decrease this liability, because remember we did record it and we oops, sorry, that line is a bit too long. We recorded it in 2021. We can decrease that liability now. We can say that it has been used up, and therefore we decrease it because the liability no more exists. We're decreasing the liability because we don't owe the worker anything, right? We no more owe the worker these 5 days. And then we have to reverse it back to the account that we raised it in. And we raised it in short-term expenses or short-term employee benefits at least. And therefore, we need to reverse it back to that same account. Okay. and that again, same sort of thing. The accrual is or the leave payable is actually a balance sheet liability, whereas the short-term employee benefit uh, cost or short-term employee benefit expense is a profit and loss account. It is an expense account. Okay, so we're reversing the liability because we no more owing the person the leave. Okay, any questions so far? Any questions? Okay, so so this is a very good question. So Nadia has asked, why haven't we recorded the 15 days and the 20 days of the current year that were taken? So remember in 20x1, the person used up 15 days of the current year allocation, okay? And we didn't pass a journal entry for that, right? And then in 20x2, the person used 20 days of the current year application. Allocation. So that's the days that they earned in that year, right? So they earned 20 days in 2022 and they used it in 2022, right? So the question is, why didn't we pass a journal entry or record that? Okay, good question. So when the work company decided on employing this worker, they built into their salary. Remember, we said they baked into their salary. They baked in that the worker needs to take leave. So those 15 days and those 20 days, in fact, so 20 days, in fact, is baked into the salary of the worker. It's baked into the 115, the cost to company. It's baked into the 115,000. So therefore, we don't need to account for it again, right? Because when we passed the journal entry for the 115, we had already accounted for 20 days. In both years, we accounted for 20 days. In 2021 and in 2022, we accounted for 20 days. The fact that he actually used less in 2021 is accounted for and is taken into account with the second journal entry that we passed, which is the one where we created that liability for 2,300. Okay. Yes, so technically it's already accounted for in the 115, in the cost to company, right? So the 20 days annual leave that everyone is allowed to get is already in that 115. So we don't need to account for it specifically when it's taken. Okay, we only need to account for the transferring and the taking of the accumulated leave, the leave that came from last year. Okay, good question. So if we have a look at the cost to company over the 2 years, right, the actual cost to company. So the first amount, which is the 115, which we are talking about just now, it's already here, right? But we created this liability, and when creating the liability, we debited or increased the expense. So we had this 2,300 increase in expense, which meant that in that year, our cost to company was slightly higher. So it was 117,300 in that year, right, in 2021. When the person actually used the leave, right, so why did we create this expense? We created the expense because we're saying uh, it should have been taken, it was not taken, and therefore we are now owing the person, right? It should have been, the 5 days should have been taken, it wasn't taken, we're now owing the person, therefore we have to make sure that we account for that by creating the liability, and obviously the liability creates an expense. Now, when they actually take it in 2022, we need to decrease the expense and then decrease the so we need to decrease the expense, but also decrease the liability because the liability is no more existing. We no more owe that guy 5 days, and as a result, we find that the actual cost to company in that year is slightly lower than 115, right? So it's 112,700. But if we add this two up, right? If we add the 2 years up and we divide it by 2 years, what is our average cost to company? Right? So our average cost to company is actually 115. So it comes back to the original amount that we said it should be. Right. So what we're just doing is we're only allocating and changing the amount between years. In total, it should even out. It should sort of work its way through the system and even out over time. Okay. Any questions so far about how do we calculate the actual cost to company? Any questions? I'm going to give you guys a few minutes to think of any questions. In the meantime, I'm going to start looking and reading the next question, which is 11.5. We should actually take a break. Let's take a 5-minute break, and we'll come back at half past, 14:31. So my clock now is 14. 26. We'll take a 5-minute break and we'll see you back at 14:31. In the meantime, I will answer questions in the chat. So someone is asking, this 230, is it the cost to company? Yes, it is the cost to the company, the actual cost to company. I don't want you to call it cost to company, just cost to company, just call it actual cost to company, because then you won't get confused. It's the actual cost to company that the company paid over the 2 years. So that's why I divided it by 2 to get the actual cost to company per year. And we saw that the actual cost to company per year is what it's supposed to be, which is 111,000. But yeah, so that's what it is. So good question. What would we have recorded if the employee or the worker had not taken the leave days, right? They had not taken the leave days. Well, in that case, and remember in this question, it's non-vesting. Okay, we've got a non-vesting amount. In that case, we would have had to eliminate the liability because we no more are owing that person the leave. So we would have passed a very similar journal to the one that we did pass. But just now, the narration is going to be different, right? The narration is not going to be leave taken, it's going to be leave forfeited. Okay, the leave is forfeited. So that will be the only difference. In the next example, we're going to see what happens if it's vesting, how the journal entry will change if it's vesting. Okay, everyone, we should be returning now, so we can continue with the lecture. Just give people a few more seconds to come through. Okay, so let us have a look at 11.5. Okay, so in 11.5, we're going to change the required and we're going to do T accounts. So the required asks for journal entries in our textbook. So again, on the same page, we did 11.4. Now we're going to move on to 11.5, which is the next question. So the question in the textbook asks for, or in the workbook asks for journal entries. We want to change it and have a look at it from the perspective of the T accounts, right? So we want to look at the T accounts. So I'm just going to read the information very quickly for us, and then we can discuss it. So it says an employee of Catto Limited earns a gross salary of 300,000 per annum since his employment on 1 January 2021. So important now. Let's just stop there and just discuss this. So firstly, it's telling us that the gross salary is 300,000, right? Remember, the important things that we need to remember for our calculations are gross salary and cost to company. But if we can't get cost to company, then we can add the contributions, and then we're going to get cost to company, right? Because remember, cost to company is gross plus contributions of the company. So it's the company's contributions. Remember, we have to make sure that it's the company's contributions. And then it tells us that he was appointed on January 2021, right? Towards the end of that sentence. What does that tell us about his possible leave balance at the beginning of 2021? So his leave balance at the beginning of 2021 is always going to be zero because he was just employed. You understand? So he can't be, what do you call it, accumulating leave because he wasn't employed during the time. So there's no way that he was accumulating leave. Okay, so let's continue on with that sentence. It says the cost to company is 600,000. Okay, great. So they've given us the gross salary and they've given us the cost to company. So it's 360 cost to company per annum. Right. So the cost to company is 360. It says Carol contributes, amongst others, 40,000 per year to a defined contribution plan. Now, what is happening here is the examiner or the test setter is trying to test whether you as a student know the difference between gross salary and cost to company. Remember, cost to company includes all of the company or employer's contribution. It includes all of it. Now, what they're doing is they're giving you that 40,000 Rand and hoping that you're going to make a mistake, right? They're hoping that you're going to think that, oh, the 40,000 Rand must be added to the 360. But it doesn't need to be added to the 360 because the 360 is cost to company. So it's already including that 40,000 Rand, right? So that difference between gross and cost to company is 60, right? So if you take the 360, which is cost to company, minus the gross, you're going to get an amount of 60,000 Rand. That amount is all of the contributions made by the company. That 60,000 includes the 40,000. So what the test setter is doing here is he's trying to trick you. He's trying to say, does the student understand that this 40,000 is already included in the 360, right? So that's what is being asked here. So just make sure that you spot that, right? So the question goes on to say the employee is entitled to 15 working days paid leave per year, and any unutilized leave may be carried over for the next 12 months. Remember what we said when we see words like carried over, carried forward, can be used in the next year. What does that tell us? What word? How would we describe this type of leave? It is a cumulative leave or accumulating leave. Yes, so that's correct. So that word carried over tells us that it's a cumulative. Okay. So it can be carried over. So the next sentence, which is the sentence that we've got on the screen now, it says carried over leave not utilized during the 12 months after it was carried over. So now they're saying it originated in 2021. We carried it over to 2022. Yes, the session is recorded. Let me just double check. Yes, the session is recorded. The leave was originated in 2021, was carried over to 2022. And when it was carried over to 2022, if it wasn't used for the whole of 2022, that's what they're telling us now. So let's read it again. Carried over leave not utilized during the 12 months after it was carried over. So now they're talking about it wasn't utilized in 2022 at all, right? It says will be paid out in cash to the employee. So when we're talking about paid out, when we're talking about can be converted into cash, what type of leave is that? When it can be converted, when it can be paid out, we call it correct vesting leave. Right. So now we're dealing with a situation where our leave is cumulative and vesting. Okay. So that's we've identified that correctly. It says the next sentence says it is the company's policy to first utilize the cumulative leave before the current year's leave can be utilized. So it's just talking to us about FIFO, okay? First in, first out. So that's what it's just talking to us about. Unlike in inventory, sometimes you might be able to use LIFO, but because it's disadvantageous to the employee or the worker, not many companies do it, okay? But it is a possibility. I would suggest that you read your question very carefully when you get it in your test or exam. And if you don't, then you can assume that FIFO will be used, right? So FIFO is our fail-safe if we don't see any statement on the method of which the leave is used. But generally, you will get a statement like, specifically in back to 100, you're going to get a statement, or you might get a statement like this one. Right. So the next sentence says, the entity assumes all carried over leave will be used, not paid in the next year. So what is it telling us there? It's saying the entity assumes all leave, so all carried over leave will be used and not paid out. So what amount is the question telling us to use? Remember we said at the beginning we've got a rule, if the leave is used, it equals some amount, and if the leave is paid out, it equals some amount. So this statement is telling us to use what amount? Is it gross or cost to company? Correct. Right. So that's right in the chat. This question is telling us because it's being used, we have to use our cost to company amount. Okay. Now, if we look, so the required, we're going to read it just now, but I'll tell you already. So someone says, why is it vesting? It says it's vesting because in the middle of the paragraph, it says, or even if we look on the slide, so if you guys pay attention to the slide, I'll tell you why it's vesting now. So it says it can be paid out in cash. So that's why it's vesting, because it can be paid out in cash. But the statement that we just read now tells us that they are telling us nothing will vest. So they're saying it will all be used. Nothing is going to vest. So it's saying nothing will vest. Even though it is a vesting type of leave, nothing is going to be allowed to vest. it will all be used. And we know that when everything is being used, we have to use cost to company. Only when it vests, then we're going to use uh, 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 gross salary, right? So even though it's a vesting type of leave, it's not going to be allowed to vest. Okay, so the next statement says the company's year end is 31st December, and the year has 250 working days. So again, remember, we always need to make sure that we get the 250 working days, and we need to look at our question to see if there's any indication of whether it's FIFO or LIFO. Okay, that generally in these types of questions, it's going to come as a standard sort of statement. You're going to see it in all questions, but the amount of 250 might not always be 250. It can change. So just make sure that you pay attention. And then it's got a table for us. Now I've put that table in a little. Sorry, it's got the usage for us. I'll put that usage in a table on screen now so that we can see it and makes a bit more sense to us, right? So the person is allowed to have 15 days. So remember what we said, the 15 days is baked into the salary, right? The 15 days is already accounted for in the salary. So they allowed 15 days. In year one, so in 2021, they use all 15 days. There's nothing to carry forward. There's nothing to vest. There's nothing to accumulate. We can't accumulate anything because everything is used up. So we end up with 0 days, which is here. I've highlighted it in blue or underlined it in blue. 0 days has accumulated. So nothing is accumulated for 2021. 2022, they got 15 days. They only used 9 days. And therefore, these 6 days that I've now underlined are being accumulated, is being accumulated. So then we stop and we say, is there any limit to the amount of days that can be accumulated? Remember in the previous question, they told us the limit was 5. So we read the question again. Is there any limit? As we read the question, we're going to realize that there's no limit. So they can accumulate as many leave days as they want. But it's a good practice for you as students just to ask yourself the question, is there that limit, right? Because if you don't ask yourself the question, you're going to forget and you're not going to actually take it into account. Okay, so he comes into 2023 with 6 days, right? He earns his 15 days, which is the normal 15 days, and he takes 21 days. So he takes all of them. He takes the 6 days from 2022 as well as his 15 days that he earned in 2023, right? So he's taken all of the days. Now, if we go back to the required, let me just go back one more. And it says here, prepare. So part A says, prepare the leave accrual. So the provision, they're only looking for the provision. Prepare the leave accrual account, the T account, for the years 2021 to 2023, right? So for all the years. Then part B says prepare the leave accrual account, so the T account again, only for 2023. And then it says if all the leave available in 2023 was paid out. Okay, all the leave available in 2023 was paid out. Right, so 21 days that we see there was paid out. Carried over, oh yeah. So the question says only the carried over leave can be paid out. So the 6 days is paid out. Okay. So does everyone understand the difference between the two requireds? The one required is says assume everything in the question happens as the question indicates, and we know that the sentence that I'm putting a bracket around now tells us that even though the leave is vesting, nothing will vest, right? So part A says assume that this happens. Even though the leave is vesting, nothing will vest, right? That's what part A says. Part B says ignore this statement. So for part B, for this section here, we must ignore this sentence. We must assume the sentence does not exist. And we must assume that all of the accumulated leave that is there vests. Okay, that's what we're being told, right? So that's what the two requireds are telling us. So we had a look at the slide. Let's have a look now at what happened. So in year one, we're carrying over zero, right? In year one, we're carrying over zero. Therefore, there's no journal entry that needs to be passed. So the opening balance of year two is going to be zero, right? So there's no journal entry passed in year one, and the opening balance in year two is zero. So in year two, we're going to take 6 days, right? Now, what amount are we going to use? You guys already said it. We're going to use the cost to company. And the cost to company is not 360 plus 40, right? Remember, that's the examiner was trying to test us and see if we understand the relationship between cost to company and gross salary. And they were trying to trick us there. So it's not what I've noticed some students might do is they'll take the 360 and add the 40 to it. But the 40 is already included in the 360. Okay, so the amount that we're going to use is the cost to company of 360. So that's what's happening here. We're saying 360 divided by 250 to get an amount per day, a cost per day, a cost to company per day, right? And then we multiply that by the number of outstanding days, which is in the second year, the number of outstanding days is 6 days. So when we take 360 divided by 250, we're going to get an amount of 1140, right? So 1140 is the cost to company per day. And then we're going to multiply that by 6, and that's going to give us the 8640. Okay, so that's the liability. That's the amount of value that is being transferred from 2022 to 2023. Okay. Now, in 2023, remember we're dealing with option or required one. So we must assume that nothing vests and everything is used. So we are going to account for it at the cost to company. So when it's used, we already have this amount of 8640 in the account, in the liability, and we want to reverse that. So we want to take it out because now it's being used. We no more owing this person the 6 days. They are no more our basically creditor. They can no more hold us accountable for these 6 days because it's now used. So we reverse it and we decrease, we debit the liability. We take it out. And therefore we end up with a closing balance. So this here, guys, this balance here is actually our opening balance, right? So this is the balance coming from 2022. And this amount here is our closing balance, okay? So this is CB, closing balance, and that is OB, opening balance. So the closing balance is going to be 0 because he's taking over how many days? He's taking over 0 days. So our closing balance is going to be, it looks like I'm pointing up, but it's actually I'm pointing at the 0. So therefore we need to have a closing balance of 0. Okay, any questions so far? Does everyone understand this? Okay, so now in B, they're telling us to not, we don't need to record everything, we just need to start. So B, I'm going to put a line here. B actually only starts here. So B only starts at the beginning of third year, or the beginning of 2023. So that balance, opening balance that we saw in the previous slide is this amount here. So it says we assumed that they were going to take the leave. So because we assumed that they were going to take the leave, right, we obviously accounted for it at cost to company. We assumed that they were going to take the leave, therefore we accounted for it at cost to company, which was the right thing to do, and therefore we got a liability of 8640. 1,440. But what actually happened is that they did not take the leave. Okay, so we assumed that they were going to take it. They did not take it. So we need to pay the amount out. But when we pay amounts out, we don't pay it out at cost to company. We only pay it out at gross salary. So that means we need to recalculate the amount that needs to be paid out. And that means we need to calculate it based on the gross salary, which is 300,000, divided by the 250 days, and we're going to get an amount of 1,200. We times that by 6, and that's going to give us 7,200. Okay, so 6 because that's the number of days he brought over from 2022. So we're going to get an amount of 7,200. So that's the amount that's paid out. Therefore, we have to have bank there, right? So when you guys are preparing for your exam, make sure that, like, because we know that this amount is getting paid out into cash because it's vesting, we have to have bank there. That shows conceptually that you as a student understand that the amount is being converted into cash. Now, this next journal entry, so after we pay out those 6 days, we don't owe the guy anything. We don't owe the worker any money because we've paid out the 6 days. So whatever is left over, the excess between the two amounts, right, is what we would call an adjustment. But only for learning purposes are you allowed to call it an adjustment. You must never call it an adjustment when you're writing the account name. So I don't want to see the word adjustment here, right? So in your mind, you can call it adjustment. We have to send that adjustment back to the account that we raised it in. And if you look back at the previous year, we actually raised it in the short-term employee benefits. Okay, we raised it in that amount, in that account. And so then we have to take it back. We have to take the adjustment back to that account, and therefore we take it back to short-term employee benefits. It's the difference between the amount that we raised and the amount that we actually paid out. And that we come to an amount of 1,440. It is just by coincidence that this amount of 1,440 equals this amount here. So this, so the 1,440 that we calculated here. Let me just change my color. So the 1,440 that we calculated here, where the red dots are appearing, is just a coincidence that it's the same as this amount here. So don't think that you can calculate it by just using the cost to company per day. It's not. That's not how it works. Okay, so that's just a coincidence. Any questions? Does everyone understand what happened? So in section A, the cost to company here, or the 1,444 here, is the cost to company per day. That's what it is. It's the cost to company per day. Whereas in part B, the 1,440 is the difference between the amount that was raised and the amount that was actually paid out. Okay, so they're totally different amounts. They've got nothing to do with each other. And it just so happens in this example that the amounts are the same. They've got nothing to do with each other. One is the cost to company per day, and the other one is the difference between the two. In most of your answers, in most of your examples, this amount is going to be totally, the amounts are going to be totally different. Okay, so there's no relation between the amounts. Okay, so that was basically the end of the first lecture. And we're almost at the end of the second lecture. Let's quickly, I just want to, let's just take a break before we talk about, what you call it, profit. I just want to circle back to a question that I have for you guys on, the bonus, on the leave pay. So let's do this poll quickly, and then after we do this poll, we'll go back to our lecture, which is on profit sharing now. So this is the last poll that we're going to have on leave pay. Okay, this one is a little bit more complicated, but I'll talk you through it. Okay, so it tells us that we need to calculate the leave provision. We're told that we have 500 employees. Okay, the cost to company for each of the employees, right? So let me highlight that. For each of the employees is 60,000 per year. So the cost to company is 60,000 per year for each of our 500 employees. Each employee gets 20 days accumulating leave. None of the leave is vesting. Okay. Assume that the staff remain employed for a minimum of 2 years. So that's telling us that no one is gonna, it's not vesting, no one is gonna forfeit any leave. So that's what that statement is telling us, that no one is gonna leave and resign and forfeit the leave, right? So we must assume that there's no change in the number of 500. The 500 employees stay stagnant, okay, over a period. It then says the salary is going to increase by 20%, okay, in 2022. So remember we said when we're creating a provision, we're not looking back with this provision. We're looking forward. We're saying we're going to owe this person in the future, we're going to owe them this amount. So therefore, if there's an increase in the salary in the future, we need to take it into account in our calculations. Okay, so we need to increase the salary amount by 20%. Okay, so then it says at the beginning of 2022, there's an average of 3 vacation days that will be transferred to the 2022 year. Okay, and we must assume that the employees or the workers are going to use all the days available in 2022. So they're going to use the 3 days plus the 20 days that they get. So they're going to take 23 days of leave. Okay. It then tells us, now this is the complicated part, it tells us there's a 5-day week, but we must assume 365 days in a year. Okay, so there's a 5-day week, but we must assume 365 days in a year. Okay. Now let's start off in calculating. Okay. So we're going to start off with, so if you guys can see, oops, what's going on here? Let's try that again. Okay, so we've got 60,000 Rand per employee. Okay, 60,000 Rand per employee. We're saying that there's 365 days in the year. Okay. That gives us a rate per day, correct? That gives us a rate per day. However, the employees, the workers, don't work all 365 days. You see, they only work for 5 days of the week. Okay, they only work for 5 days of the week, but we've got a rate assuming that they're going to work every day of the week, because we've used 365 days, and there's 365 days in the year, which includes the weekends. So we need to try and find a way to exclude the weekends. Okay, so how would we do that? We take our rates that are calculated at 365 days a year, right? So we're going to take our rate and we're going to say, let's see if we can't work out what is the rate per week. Okay, so the rate per week, in order to get the rate per week, we're going to take our daily rate times it by 7, and that's going to give us a rate per week. Okay, and we know that in that week, even though there's 7 days in the week, the person only works for 5 days. So we're going to divide that rate that we got by 5. And that now is our rate per day. Does everybody understand what I did? Or shall I go through it again? Okay, so we took the 60,000, we divided it by 360 days because they told us to assume 360 days, right? But we know that the workers don't work on the weekends, so we need to exclude the weekends. They only work 5 days in a week. So we get an amount per week, right? And but to get an amount per week, we have to multiply the rate that we just calculated by 7, and then we divide that rate by 5 to get a rate per day. Okay. Now, if you put that into your calculators, so let's type it out together. 60,000 divided by 365, right? 60,000 divided by 365, we should have 164.38. Now we're going to times that by 7. We're going to get an amount of 1150.684. And then we're going to so that's our weekly amount. That's our amount per week. Then we're going to divide that by 5 to get an amount per day. And our amount per day, if I can type out here, our amount per day is going to look something like 230.1369. Okay. Does everyone get that figure? Tell me in the chat if you know how I got that figure. Okay. So far we've worked out our rate per day. Okay, we've worked out our rate per day. Now we need to increase that rate because they didn't take over only 1 day, they took over 3 days. So we're going to say 230.369, let's say. So we're working to the 4th decimal place, times 3 days, because each person took over 3 days. Okay. But now we've worked out the amount for 1 employee. So we want to work it out for how many employees? 500. So we say 500. Okay. And what amount do we get there? So let's do it together. So we got in our calculators 230.1369, right? And then we times that by 3. We get an amount of 690.410. Okay, let's do that. So we times the 230. Let me actually not use the decimal places. Let me just do it the way you guys would do it so that I get an amount that's very accurate. Times 3, and we get 690.4107, right? So that's for 1 employee. That's the cost for 1 employee. And we times it by the number of employees. So now we get an amount of 345,0205.36. Okay. But what have we forgotten? We've forgotten to increase this amount by the 20% salary increase that's taking place in 2022. How do we increase this amount by 20%? We times it by 1.2, and I'm using 1.2 because the salary is increasing by 20%. So 1.2, and the amount we're going to get is, well, now that I've taken you almost to the end, you can answer. I'm going to put up the thing now. Okay, so you guys can answer now what you think the correct answer is. So there's 15 people that have, 14 people haven't yet answered. Okay. So you guys can continue answering, but this is what the poll looks like currently, and the correct answer is B, right? Just like most of you all have sort of concluded that the correct answer is B. So let's have a look at that calculation. So this is what the calculation is, very similar to what we already did. They have taken the 365 and divided it by the 60,000. They multiplied it by 7 and divided it by 5 to get an amount per day. They then multiplied it by 500 and then 3 days used per employee and then 20%. Now, if you had done it differently and if you had taken the 20%, right, and applied the 20%, oops, shucks, what a big one, and you apply the 20% to the 60,000 before starting, you would have gotten the amount in red. Your answer is still right, okay? So your answer is still right if you got the amount in red. And during the test, we are aware that students might, sort of apply the different calculations slightly differently to the way we would. And so we are lenient when it comes to rounding. If you look at this example, the rounding is about 10 Rand. So it's quite material, but we're aware that that's one of the things that will happen. And so therefore, we take that into account while marking. So you'd still get your full marks, your full allocation if you got that amount there in red. Okay. Any questions about this example? Does everyone understand exactly why we did everything, right? So the recording will be available, but you need to understand why I've done every step of the way, so that you know for yourself. Okay, I'll give you a few minutes to decide on any questions that you want to ask about this before we continue with the bonuses. Just a few seconds. Okay, seems like there's no questions. I'm assuming everyone understands that. So if you get something similar to that, maybe instead of just doing it for one group of employees, maybe you're doing it for more employees. So maybe just like you saw that calculation there was for 500 employees. Maybe I'll say, 500 are workers, and that's what the calculation must look like. But then there's also 10 managers, and so you might have to do a similar calculation but with different numbers, for example for 10 managers, and then add the two. Will you be able to handle something like that in the exam or test? And if you can't, then you need to tell me now why you can't do that so that we can work through it. Okay. Okay, so let's talk a little bit about bonuses. So bonuses and profit sharing is the last short-term employee benefits that we're going to deal with, right? So and also I'm aware that we're going to end the lecture in 10 minutes. So I'm not going to take too long with this one. First thing is the rule still applies with short-term employee benefits. It has to be paid 12 months after the work has been done. So if the work was done in the 2021 year, right, and you earn a bonus because of the good work that you've done in 2021, before December 2022, the amount has to be paid out. Okay, so it has to be paid at a minimum 12 months after, sorry, at a maximum 12 months after the work had been completed. So if the work was completed in the 2021 financial year, it must be paid before the end of the 2022 financial year. Okay, so that same rule applies when it comes to all short-term employee benefits. And the same rule applies here with regard to bonuses. But I just wanted to put it there because if in some cases you have a situation where the bonus can't be paid before that time, and it needs to be paid after 12 months after the work had been done, then we just reclassify it from short term to what we call other long-term employee benefits, which we're going to learn about next week, Tuesday, right? So we call it short-term employee benefits. There's not a major change. It's just a little bit different in terms of disclosure. Okay, so there's nothing too crazy that you need to worry about there. Recognition. So now we come to this topic of suspensive conditions. Suspensive conditions are conditions that prevent us from paying someone their bonus, right? So the bonus is in suspense. You know, when something is in suspense, you're like not really sure, do I pay it, do I not pay it? So there's things called suspensive conditions, which means a suspensive condition, for example, might say, you know, if someone does good work in 2021, they are entitled to a bonus. However, the bonus can only be paid out if they remain employed for 6 months after 2021. Now, that is a suspensive condition, right? So in December 2021, the person did good work, they're entitled to the bonus. But we can't pay it out until they have remained employed until June 2022, right? So we have to wait, we have to withhold that money until that suspensive condition is met. Okay, we have to keep the money back until the suspensive condition is met. And that is when, only when the suspensive conditions are met, or it is reasonable that the condition will be met, can we raise the bonus provision. Okay, so the bonus provision can only be raised when there's no way that we can avoid paying it. Okay, there's no way that we can avoid paying it, or based on our knowledge and our predictions, we know that we are going to be required to pay it. So when you're reading your question, I want you to be just very careful about suspensive conditions. How do you spot a suspensive condition? In the information, it will say the bonus is paid, and then it should have like a thing saying however, or but, or it might even say only when this condition is met can the payment happen. So those are the types of words you're going to watch out for in your question to make sure that you spot the suspensive condition. So only once that condition is met can we raise it. So in our example now, where someone has worked for the whole of 2021 and in December they are entitled to their bonus, but there's a suspensive condition that they must be employed for 6 months after they earned it, we can only raise the bonus provision when we are sure that they're going to stay for 6 months, or if the 6 months is already passed, right? So if it's already in the past and we're confident that they have already stayed. So for example, in December, if we're sure that this person is not going to leave, maybe they signed a contract or whatever, if we're sure that they're not going to leave, then we could possibly raise it. But there's always going to be that doubt. But if there's no doubt that they're going to stay there, then we can raise it, or if it's already happened, right? If the condition is already met. So sometimes you might see in your questions, it says it can be reasonably assumed that the conditions will be met. And then you know, okay, if it can be reasonably assumed, then I must raise it. So that's important, right? And generally, when you get that type of question where they say, oh, it can be reasonably assumed that the condition is met, you need to look out for the type of adjustment type journal entry that we passed in example, what is it, 11.5b. You remember, we raised it because we thought, we reasonably assumed that everyone is going to use the leave, but then someone didn't use the leave and they actually took it as a payout. And so then we had to adjust it, right? So when you see in your question, oh, reasonably assumed, you can think, oh, okay, I need to look out for that possible adjustment that might come through later. Okay, measurement. Now this is important, guys. Measurement, there's no rules about the formula that can be used to calculate performance bonuses or profit sharing bonuses. Okay, so there's no rule in accounting, which means you are going to have to identify and find your rule uh, in the question. Okay, you're going to identify and find that formula. So I'm talking now about measurement, right? So the formula that you're looking for here, it's only coming in the question. So I need you to be super, super, super careful when you're reading the question, because it will say something like, the person earns a bonus only if they get 10% above their target. So now you need to find the target, you need to calculate 10%, and then you need to look at what the actual was and make sure that the actual is above that 10%. Okay, so that can be something that you might find, or it might say the target is 10,000 rand, right? And whatever amount is earned over 10,000 rand, or whatever amount is sold over 10,000 rand. I'm talking about a sales representative. This is often how the sales representative bonuses are calculated. So they'll say, oh, the sales representative's target individually is 10,000 rand. If he sells more than 10,000 rand in 1 month, he receives 10% of the additional sales that he made. So then we take the target of 10,000 rand, we look at the actual, so the person actually sold 12,000 rand, and then we say 10% of that 10% of that 2,000, which is the extra, the surplus, is 200 rand. So that's how we're going to calculate. So the formula, you need to be super careful about reading the question, because that's where the formula, that's where you're going to find your formula. There's no like rules. Remember when we did leave pay, there were like rules. Okay, if it's paid out, we're going to use, gross pay. If it's used, we're going to use cost of company. It's not like that when it comes to bonuses. The formula is only found in the question, and each question will have a slightly different formula. So we're going to do an example though, so don't stress. And then it says the amounts that we calculate must be recorded in the AFS, obviously if the suspensive conditions are met. And sometimes what you might find is that there's no the company might not have a written down formula, so it might not be written in words. So like this amount times that amount times it might not be like that. It might be they'll tell you in the past this is how the bonus was calculated, and so you need to know that the past practice can actually tell you how to measure it, because if they've created a perception and an expectation in the workers that they're going to calculate it in this way, we have to use that when we're calculating the bonus provision. Let's have a look at a question. So one of the questions say, is a suspensive condition a constructive obligation? So when it's met, right? So when the condition is met, then an obligation exists. But if it's not met, then the obligation doesn't exist. Okay? But also, like I said, just watch out for your questions where it says you can reasonably assume that the condition will be met. Yeah. Okay. So I think in that question we're talking about two different things. So an obligation is the result of the condition being met, whereas a condition is some sort of requirement that the company places on the employee or the worker, right? So the suspensive condition is some sort of requirement that is placed on the worker by the company. And only once that condition is met, then we can say that an obligation exists. And therefore we need to raise the liability. Okay, any questions? So we've come to the end of our lecture today. We are a little bit behind, but like I said before, when we come in lecture 5, which is the next lecture on Thursday, I'm hoping to catch up a little bit. So in the next lecture, we're going to look at the introduction to IFRS, right? So I'd like you to read over this example so that we can go through it quickly. So the introduction to IFRS 11.6. So here you're going to find that the formula is spoken about, and they're going to give you a type of formula that you might need to look at and see how they've set it out, so that you know that when you get your test question, you'll be able to identify what the formula is. Okay, so for today, our lecture has come to an end. Thank you guys for sticking around and sticking with me. I know it was a long one, and I'll see you on Thursday. I'm going to stop the recording now.